Hey, what's up everybody? Welcome back to the channel. So today we're going to be doing another backtesting video, and we're going to be looking at one of the more famous dividend investing strategies, which is called the dogs of the Dow. So this strategy, it was initially popularized in a 1991 book by someone named Michael O'Higgins, which is called Beating the Dow. And it's actually a very, very simple strategy. Basically, all you do under this strategy is you just look at the 30 companies that are on the Dow Jones Index, you rank them by dividend yield, and you buy at equal weights the 10 highest dividend yielding stocks. You hold them for 1 year, and then you rebalance the portfolio after 1 year. So that's all the strategy is. And it initially caught a lot of attention after this book got released in 1991 because the returns in the 20-year period that followed this book being released, so from 1992 until 2011, they actually beat the market, not just the Dow Jones Index, but it beat the S&P 500 as well, where this strategy returned about 10.8% per year, whereas the S&P 500 did about 9.6. So that may not seem like a lot, but 1.2% per year over 20 years, that certainly adds up. In fact, that's the difference between turning $1,000 into $7,776 versus turning $1,000 into 6,255. So it's a pretty big difference overall. So whenever you hear stats like this or you hear about some super simple strategy that's outperforming the market, it makes you think of two possible things. One is that it was just a coincidence, right? And it was just this one specific time period where this one strategy has just happened to work out. And if you're to try and follow it today, it may or may not still work. The other explanation is that maybe there's actually something to this strategy where, in some way, it enables you to exploit investor psychology to your advantage. And it did outperform over a pretty long time horizon, right? We're talking 20 years here. So this wasn't just something that worked for a couple years. I mean, 20 years, I think most investors would consider that long term. And I want you to also consider what the name of this strategy is and really what the intent of this strategy is, right? It's the dogs of the Dow, right? So what do they mean by dogs? Well, they mean companies that have fallen out of favor by the investing public. And really, if you think about it, there's numerous strategies that have been created and talked about in books that talk about basically forcing investors to buy companies that they otherwise wouldn't buy. For example, there's the magic formula, right? That's kind of the intent of the magic formula. You're buying companies that have high returns on capital that are trading at very cheap prices, which if you're to try and, manually research those companies, you would probably get to a point where you're like, you know what, I don't think this is a good investment just based on where I see the business going. But we're just looking at, quantitative criteria under these strategies to force us to buy companies we otherwise wouldn't. There's also the acquirer's multiple, right? Which, again, very similar idea. Basically, you're just buying companies that are trading at cheap prices, which they determined using the acquirer's multiple that was talked about in that book. So, really, the rationale behind this strategy is that you are buying stocks that have high dividend yields. And because they have high dividend yields, they probably have that because they've recently declined in price. So, of all the 30 companies that you can find on the Dow index, which are these companies here, you're buying in theory, the 10 cheapest ones, which honestly, I mean, it sounds like a pretty good strategy if you think about it, right? That could work over a long period of time because, I mean, yeah, there's going to be some years where a strategy like this doesn't necessarily outperform the market, and I think that's to be expected, but I think we can all agree that in general, buying large, reputable blue chip companies at relatively cheap prices is a pretty good strategy, right? It's pretty hard to, do terribly in investing following a strategy like that. You may not outperform the S&P 500, but you're probably going to do decent over a long enough time horizon. And you're just buying the 10 highest yielding stocks without doing any manual research. You're not trying to time the market by buying into companies at the right price. So all the potential for human error that comes from us trying to, pick the right companies and time the market, all of that gets isolated out, right? You're just following a very rigid set of criteria under this strategy. And the reason I'm talking about this is because we know that from studying active managers, humans in general just suck at picking investments, right? And I think that's documented pretty well. I think most people watching believe that to be true, but I have some data here that does also back this up. So this looks at different asset classes. We have US large cap, US small cap, international funds, and these are basically just investment funds that are actively managed. And the further out you go in time, so 1 year, 3 year, 5 years, 10 years, 20 years, what percentage of those funds are consistently outperforming their benchmark index, which for these US companies would probably be the S&P 500. Well, if we're looking at a 1 year time horizon, it's basically just 50-50, right? It's, basically just throwing darts at a dartboard. Some companies do it or some funds do it, and then, but a lot of them, aren't able to do it yet. As you get further and further out, less and less are, actually outperforming. This is the percentage that underperformed. Once you get to 20 years, you're looking at close to 95% of funds that can't even outperform their basic benchmark index. Now, personally, I don't think, I'm not saying this because I think all active management is bad. I think that it's certainly possible to beat the market over long periods of time. And I think that there is a very, very rare breed of investor that exists out there that they have a certain demeanor towards investing that they're just naturally contrarians. They think differently than most people. And certain people have the ability to outperform over long periods of time. But I also think that when it comes to these kinds of investment funds, you're much more likely to encounter people that are essentially just salesmen. They're much better at convincing you that they have some golden strategy that can outperform the market, which gets you to invest in their funds. There's a lot more of those people than there are people that actually have that rare skill set to beat the market consistently. So, anyways, the point that I'm trying to make here is that any sort of stock picking strategy that you hear about, whatever it is, it has to work because the reason that it works is because it isolates out all forms of human bias that can occur if we try to manually pick companies using our own research and trying to time the market, right? And basically just by forcing us to invest in companies we otherwise wouldn't invest in. So the question is, could that be the case for the dogs of the Dow strategy? Well, to answer that, one question that I'd like to pose to all of you watching is how are the companies on the Dow Jones Index actually determined? Well, they're not determined by some objective set of numbers-based criteria. They're determined by a committee of people that have meetings that get together and decide which companies get to be included in this index and which companies are going to be removed from the index. And the factors they look at include the company's reputation, for one, its history of sustained growth, its interest to investors, whatever that means, and its sector representation of the broader market. And by the way, that's how the S&P 500 companies are determined as well. There's a committee of people that decide what companies get removed and what companies get added in. So my point is that even the stocks on the Dow Jones Index themselves are there because of human judgment, right? Which we know is imperfect and it's subject to bias. So I think that's one issue that you run into when you're trying to explain why a strategy like the dogs of the Dow could work and it could outperform the market consistently is because you're essentially relying on a committee of people to gatekeep the pool of stocks that you're allowed to pick from. But I think, just going higher level on this, the whole essence of this strategy is buying low risk, high dividend yielding stocks trading at relatively low valuation multiples. That's a strategy that has been proven to work. For example, this graphic here, which is a pretty famous graphic, I'm sure some of you guys watching have seen this chart before. But basically, it looks at over the past 50 years how a $100 investment would have performed in various cohorts of companies, all relating to what their dividend policies have been. So at the top, you have companies that have grown dividends. You have in the dark blue companies that have just been paying dividends. And then in the green, you have a equal weighted index of S&P 500 companies. In the brown here is companies that haven't changed their dividend policy. Orange is companies that don't pay dividends. And then you have the dividend cutters, which would probably be companies that face some kind of business trouble. And that's the worst cohort as you'd expect. But the point is that, as you can see, the more aggressive companies were, and the more generous, I should say, they were with paying dividends, the better results that you saw. Now, I don't want you to see this and then just suddenly think that there's something magical about dividend investing, because the reason that these companies did the best is not because they just pay dividends, it's because the businesses themselves have certain qualities that enabled them to pay dividends. They were just better at cash flow generation overall, which could be due to a number of factors, right? They probably have some kind of economic moat that they built up over 50 years. They probably have a very, well-rounded business model that can remain profitable through various stages of the business cycle. And my point in showing this is that it's possible that the dogs of the Dow strategy just works because it's essentially a barometer for buying higher quality dividend paying companies at relatively cheap prices, which is a strategy that we already know is going to work out pretty well. But anyways, that's enough theoretical talk. Let's actually look at some cold hard evidence. How has the dogs of the Dow strategy performed over the past year, over the past 5 years, over the past 10 years? Does this strategy still work today? And the way I'm going to do this is I'm going to use the backtesting feature, which is on my website here, which is called tickernomics.com. And this is a website that I created, by the way, which is designed to really just help give retail investors better access to data and help them analyze companies. So it has all kinds of features you can see, and we currently have Canadian stocks, US stocks, and also international stocks on the website. So if you are interested in playing around with this website, it's currently free to use. Then the link to it will be in the description of this video. But anyways, we're going to use the backtesting feature here. We're also going to use scripting. So scripting is a unique feature that I added to this website. And you can basically think of it like custom analytics that I and other users of the site have created for people to use. So you go to public scripts here, and all these things, you can run them, and they all do unique things. For example, I created one that's just called the Dogs of the Dow, which I'll go to this, and then if I click run, we'll see that this basically it generates a list of the current dogs of the Dow companies. So I'll run this and it takes a few minutes to generate the chart. And here it is. So these are the 10 companies that you would buy if you were to start following this strategy as of today. And one interesting thing to note is if we look at the betas of these companies, remember beta is essentially a barometer for risk, right? A higher beta means a more risky company because it moves in more extreme ways with the market overall. So companies with lower betas are generally less volatile, right? Their stock prices don't move quite as much, which not everyone agrees that beta is the right measure of risk, but let's, for the purpose of this, just assume that it is. There's only one company that has a beta over one, which is GS, which is Goldman Sachs. Most of these companies have betas below one, which means they're less risky than the market overall, which is interesting because when we think about strategies that can, say, outperform the S&P 500, the companies that have lower betas are basically, you would call that, generating alpha, because what alpha is a return that is in excess of what the expected return is for the given level of risk. So if you can beat the S&P 500 with a portfolio that has a beta lower than one, then you can kind of assume that that's generating alpha. That's a bit more theoretical, but I just thought that that was an interesting point to bring up. Now let's see how this strategy would have performed over the past year. So I'm going to use another script which is called Dogs of the Dow 1 Year Backtest, and this one's also available for the users of the site to run. So you go here and then you can just click run, and it's going to generate a list of the companies if you were to start following this strategy 1 year ago, and then also what the actual returns would be, which is the column over here. So the best performing company was INTC, I believe that's Intel, which had 56%, but there's also some that didn't do so good. For example, WBA, which I believe that's Walgreens, was negative 40%. And I did also extract this data into Excel, which you can do that as well. And I'll just quickly calculate what the average was for this portfolio overall. So we can see, how well does a strategy like this actually perform over the past year. And it gives us some good evidence. So just over 7%. Now the S&P 500 over the past year has done roughly 12%, I think. So you would have underperformed, right? But that's just 1 year. Again, we know that a strategy like this is going to underperform a little bit. So let's try using the actual backtesting feature. So the way we're going to do this is I've already kind of created this strategy, but basically you're for the backtest type, you're going to do a ranked buy and sell because we're ranking companies based on dividend yield. And we can add other things. So we'll say we'll do a 5 year backtest. So the start date will be about 5 years ago, so early December of 2018. We'll assume that we invested 100,000 US dollars. We're limiting it to 10 positions. We're rebalancing annually. And for the buy conditions, we just want to look at companies that are on the Dow Jones Index, which the way you do this on the site is you type in tags here, and the tags can either be S&P 500 if it's an S&P 500 company or Dow. So I've already entered the Dow one here, and then the buy ranking. So this is basically the formula that the backtesting algorithm, you can call it, is going to use. You basically just enter the dividend yield, so this here, and then if you're going to use multiple metrics, you could use a multiplier, which can assign a weighting to different metrics. to make certain metrics more important or other ones less important depending on what you're trying to backtest. But I've already entered it and we'll just do a multiplier of 1 for the dividend yield. So we'll click run and it'll take a few seconds to run and then it generates our backtest here and we can basically benchmark it to the S&P 500. We'll wait for it to completely finish. And there we go. So over the past 5 years, the main thing we want to look at is here, the annualized return. So just over 10% is our annualized return. Now, over the past 5 or so years, I believe the S&P 500 did more than that. It did about 10.5% over the past 5 years. So, and then if you are interested as well, you can actually look at the specific transactions that you would have done. So these are the 10 companies we initially would have bought. You would have sold these ones and then bought these companies here, and so on and so on. So it underperformed over the past 5 years, not by a lot, but by slightly. And considering that the companies on average have lower betas than the S&P 500, that's not bad overall, right? You can even consider that generating alpha because you're taking on less risk by having a portfolio with a lower beta than the S&P 500 and you're almost at, the return that it generated. You're just off by zero point 0.5. So to me, that's a pretty good strategy. Now let's try it going back 10 years. So I'll change the date to 2013, December of 2013. We'll go December 10th. We'll keep everything else the same. And we'll click run. It's going to take a bit longer to run this time because it's got some more data to plow through. But I am curious to see over the past 10 years because we know looking at data before that, over a 20-year period, it outperformed. So we get an annualized return of just under 13%. Now, what's interesting is that the S&P 500 over the past 10 years did just over 12%. So you would have actually outperformed using this strategy. And again, here are the specifics of the companies that you would have been buying and selling. And this does account for dividend reinvesting, by the way, in case you were wondering that. So personally, I am actually quite surprised that this strategy outperformed the S&P 500. And the reason I say that is because I'm going to pull up another table that I created. So this table here is the 25 largest US stocks 10 years ago, so what their market cap was, which is this column 10 years ago, and basically what their returns have been since then. Because what we've seen over the past 10 years has been quite unprecedented, where we can see 10 years ago, the largest US company, it was Apple, and the second largest one was Microsoft. And those companies have only become increasingly dominant as the years have gone on. And despite them already being the largest companies, they had amazing returns. We can see Apple had a total return over the 12 years of just under 29%. And that's 29% per year for 10 years. So that is obviously an extremely high return. Microsoft as well, just over 30%. And a lot of the companies that you see here, which were already the largest US companies, had very strong returns. We can see many returns that were in the double digits. So this really powered the S&P 500 index forward and led to, such strong performance. It's had 12% return per year over the past 10 years. These companies are obviously a big part of that. But even despite that, this strategy, the dogs of the Dow strategy, still proved to outperform this strategy, which I think is very impressive. Now, something else that I was curious to try is what if we take the same logic of the dogs of the Dow strategy, but just apply it to a broader set of companies? What if we apply it to all US companies that have a beta below 1, so still meeting that lower risk company requirement, and are still large, reputable companies, so they have to have a market cap of at least $10 billion, which I put 10,000 here because all the data on the website is in millions, so 10,000 is 10 billion. And everything else in the backtest, we're leaving the same. So it's a 5-year backtest, 100,000 US dollars we're investing, 10 total positions, and we're rebalancing annually. And then our buy ranking, again, it's just going to look at the dividend yield, nothing else. We're just ranking companies based off of the dividend yield. So we'll run this and we'll see what kind of results that we can get. And the reason why I wanted to do this is I wanted to see, is there anything magical about only selecting companies in the Dow Jones? Or if we just broaden our set a little bit, do we get better results? And what we can see is we get much better results. We get just under 19% return here. So that's 19% per year each year for 5 years. So I thought that this was very interesting because it basically just shows that, there's nothing magical about the dogs of the Dow strategy. And if you just change a little bit about the pool of companies that you're selecting from, you can actually get much better results. Now, yes, this is just 1 5-year time period. It's possible that over longer periods, the dogs of the Dow ends up doing better, but it is one data point that we can point to that I think is very interesting. So in conclusion, basically what I wanted to say is I don't think that there's anything special or magical about the dogs of the Dow strategy. What I think it's doing is it's basically just a barometer for doing another investing strategy, which is buying higher quality dividend paying companies at relatively cheap prices, which is a strategy that we already have proven is going to be a winning strategy and it's probably going to work overall. And you're also using a very rigid, a very objective rule set which isolates out all the types of human bias and error that can occur when you're manually researching companies, right? When you're trying to pick individual stocks and time the market, you're not doing any of that. You're sticking to very specific rules. And it'll probably outperform in some years, probably underperform some years. It really just depends if you get lucky and you happen to do it over a time period that ends up working out. But yeah, that pretty much does it for this video. So I hope you did find this useful. If you did, then please leave a like. And if you're new to my channel, then please consider subscribing. And I'll see you guys in the next video.